Inflation is still the main driver that the feds are looking at. They don't seem to be letting up. And when we see things like retail sales double, our first thought is, oh my gosh, is the consumer really still that resilient? And I think there's a few things that are leading to this. All right, friends, welcome back to Market Shares. I'm your host, Tony Blodgett. And I'm finding now that we've been doing this podcast for over a year, you're going to get called out on some of your past episodes when you make strong predictions. And it was pretty funny. I got called out just the other day. Someone sent me a text message of one of our episodes we did. It was just about a year ago. And it said, will interest rates go to 9%? And if you didn't see that episode, feel free to go back and watch it. I'm not going to delete it because, look, we're not always all right 100% of the time. Might be interesting to see what we were thinking about the market a year ago. But someone sent me a picture of that video thumbnail and said, yeah, this didn't age very well, did it? Because here we are, guys. We're not at 9% with mortgage interest rates, but man, it is just relentless what's going on with mortgage rates. And then today, as I'm recording this, we just had this week retail sales come out, and they doubled expectations of what the market was looking for on retail sales. And the market, the 10-year got a lot worse. Mortgage rates continue to get worse. And so I'm not going to spend a bunch of time talking about where rates are at. There's plenty of videos on YouTube that are going to go deep into that. And sometimes, I will unpack what's driving the mortgage interest rate market, but that's not what we're going to talk about today. But I just thought it was funny that, it's funny because when you make predictions like that look, you're either going to be right, wrong, or close, right? And I definitely thought mortgage interest rates would be coming down by now. They're not doing that, and there's a whole host of reasons why. I think the data that we had a year ago led us to believe that rates should be getting better. And I think that, they should be getting better based on where we see actual inflation at and so on and so forth. But we have, a Federal Reserve with a little bit different take on things, and they are going to be relentless in their pursuit of stamping out inflation. So anyway, I thought that was funny. So Omid, who sent me that text message, I'm going to have you on this podcast, brother. And we're going to have you make some predictions that we can go back on in a year and see how you do with where things turn out. But nonetheless, you guys, inflation is still the main driver that the feds are looking at. They don't seem to be letting up. And when we see things like retail sales double, our first thought is, oh my gosh, is the consumer really still that resilient? And I think there's a few things that are leading to this. And I don't think the consumer is that resilient in a market like this with interest rates where they are and all that's going on in the economy. But retail sales tells a different story. And a few things I'll highlight before I get onto the main topic of this podcast is keep in mind, gas and food are included in retail sales. And so when the price of gas continues to go up, we see massive inflation in food, which, if you remember, is stripped out of the core inflation numbers. A lot of people are spending more money, but they're not buying, consumer goods as much. They're not buying new furniture. They're not buying, toys and things of that nature. I mean, they're buying gas and food, and that's contributing to the higher retail sales. The other thing I would point out is that credit card debt is like skyrocketing. It's at an all-time high and continuing to increase. And I think what we have going on here is that during COVID, which, remember, one prediction I did make is we went through 2 years of COVID. We're going to go through 2 years of the tailwind of that. And we're definitely still in that time frame here. But a lot of people paid down their credit cards during COVID, right? There was a lot of stimulus. Savings rates went way up. People paid off their credit cards. And so we see savings rates plummeting drastically while credit card balances are going up. And you combine those two things, and I think the average consumer still feels like they have some bandwidth. They burnt maybe through some savings. They're starting to use their credit cards. No one wants to change their habits, right? They get used to their lifestyle. And this too will come to a head. But as of right now, it's continuing to fuel those retail sales numbers, and that's not doing us any favors in the mortgage market. Okay, so let's pivot a little bit. I want to talk today about different loan types, and I'm going to hit on the usual suspects. I want to spend a little bit more time here at the more complex mortgages and lending options that are out there, because I get a lot of questions on these, and I think that it might be helpful for both people in the mortgage and real estate space, but also any average consumer that might be watching this episode. So look, typically when we think about a home loan, we're thinking about a conventional conforming loan, okay? A conventional loan just simply means it's a loan that can be sold to Fannie Mae or Freddie Mac, and is pretty standard guidelines that is available to anyone who has access to originating mortgage loans. That's a conventional loan, Fannie, Freddie, pretty vanilla, pretty standard stuff. The next category that you hear about a lot is government loans. So government loans, quite simply, are loans that are either guaranteed and or insured by the federal government. And these loans are going to be going into, instead of being sold to Fannie Mae or Freddie Mac, they're going to be securitized into a Ginnie Mae security, and they're going to have some sort of a guarantee. Like a VA loan is guaranteed by the Veterans Administration, the USDA loan is guaranteed by the USDA, and FHA doesn't do a guarantee, they do an insurance program, FHA mortgage insurance. So those are government loans, they fall into those buckets. Again, widely available to anyone in the market, standard guidelines that pretty much every lender, with maybe a few overlays here or there, but mostly is going to be underwriting. These are standard loans in the marketplace. And really, those are really, when you come to just what are standard loans, it's really just those conforming, conventional loans and these government loans. So then we get into jumbo loans. Now, jumbo loans, there's a few different categories of jumbo loans. So when you think about, I work for a mortgage banking company. So when we originate a jumbo loan, most of those loans are actually being underwritten to another bank's guidelines. And so some of the more popular banks are like Citi and Chase. Wells Fargo is out of the wholesale jumbo business, so you're not selling loans to Wells Fargo. Bank of America has been out for, I think, over a decade. You're not selling loans to Bank of America, but there are big players that you can sell these loans to. So essentially, you're going to a mortgage broker or you're going to a mortgage banker, and they're going to originate that loan, but it's going to be underwritten. I mean, they might have delegated underwriting, but the loan's going to essentially predetermined that it's going to go to one of those end investors. They're going to service it in most cases. So that's your typical jumbo loan product. And keep in mind, a jumbo loan is just a loan that's too large to meet Fannie Mae and Freddie Mac guidelines. So if it's too big for Fannie and Freddie, you're going to be looking at a jumbo loan in that case. Now, here's the thing with jumbo loans though, because it's not that simple. A lot of lenders, so if I originate a jumbo loan and let's say it's going to go to Chase Manhattan Bank. So Chase is going to hold that loan more than likely in their portfolio. And we're going to talk about portfolio loans here in just a minute. But the bank, Chase or Citi or whomever it is, they're choosing to lend out the bank's money to a borrower who's using a larger home with a larger mortgage as security for that particular mortgage. And so as a result of that, in the jumbo space, there's not a set of guidelines that are going to be available to everybody. When I might look at Chase's guidelines, and they might be different as far as maximum loan to value, credit score requirements, reserve requirements, meaning how much money you have left over after your down payment, etc. So each one of these different banks that we have access to is going to have a slightly different set of guidelines. And so our job as the mortgage originator is to find the best investor and then underwrite that loan to that specific investor's guidelines, knowing that they're going to keep that loan in their portfolio. So, but this is different than a portfolio loan, right? So jumbo loans will go into a bank's portfolio. But also what you're going to find out there is there's some banks that offer just portfolio loan options. And I would say that things that would fall into this category are like non-QM loans. These are loans that do not meet the qualified mortgage exemption, but some lenders are willing to do them. And again, each lender is going to have a different set of guidelines for these non-QM loans. Other things that might fall into that category is like a DSCR loan, a debt service coverage ratio loan. That's a loan that isn't based on the borrower's ability to repay, but it's for investment properties, and you're really using the rental income to cover the mortgage payment, and you're qualifying based on that. And so these loans are portfolio loans because a bank is going to offer them. You might have access to them through a mortgage broker or a mortgage banker, but in many cases, these portfolio loans are only available at the bank directly. And so it becomes a whole different, type of a search for your home loan when you're looking for something that is in this kind of portfolio category. Now, I would typically start with talking to your local mortgage lender, and they're going to be able to give you the advice on what's available in the secondary market, what's available through their institution. And most great loan officers, you guys, if there's a product out there that exists, but they don't offer it, they're going to help steer you in the right direction, not just to find the product, but probably be able to make a recommendation to someone who they know and trust and has a great reputation in the marketplace. I know when I was originating loans, I did this all the time. And I think that if you're a loan officer and you don't offer certain products, it's really in your best interest to learn who does do them, build a relationship with them, and find opportunities to refer and endorse their products, even if you can't do it, because you want to be a resource for your real estate agents. You want to be a resource for every borrower out there. I want them to call me first, and if I can help them, great, I will do that. But if I can't do the loan for them, I can at least point them in the right direction. And I think there's a lot of value in doing that. You can still get referrals from people for doing that, and it looks really good to the real estate agents who might be referring you, because you really are a one-stop shop. And if you can't do it, you'll find someone that can. I would strongly encourage you to adopt that mindset around this. So many loan officers are like, well, if I don't do it, I don't want to tell them about this other bank because I might lose future business. That's a very scarcity mindset, and I would encourage you not to embody that and really think about how you can help the customer, because it'll come back around. Matter of fact, what you're going to find is there's a lot of lenders who might do these more unique products, but they might not do the standard stuff. They might not do FHA, VA, or USDA loans, and you could be a source for that. I mean, you just never know. So anyways, so that's portfolio loans. Those are loans made by a bank. They're going to be outside of kind of the standard guidelines, and they're going to service those loans and keep them in-house. Now, what we're seeing right now is that sometimes with these jumbo and non-QM loans, which you would think are higher risk loans, right? And so you would think that the interest rate would be significantly higher than what might be available with Fannie or Freddie on a regular conforming loan. I mean, it's a lot less risk. You would think that would make sense. But a lot of banks, what they're doing is, because they get to decide how much they're lending that money out at, and there's a lot of competition right now to pick up those loans out there. There's a lot less loans in the market. And so if you want, if you're a bank, you have to lend out money. That's a central function of how banks operate, right? They take in deposits and they lend out money. Well, when there's less opportunities to lend out money, you might get more aggressive in your pricing. And so all of a sudden, you might see a loan that you think is a higher risk loan, or it's outside of the standard guidelines, but a bank's willing to give a really competitive interest rate on that because they need to deploy that capital. Now, they're not going to be as low as what we saw in the past, because they're also paying out a lot of money for those deposits, right? If you've noticed, the amount of money you're earning on the funds you have deposited with the bank are going up. So that's really their cost of funds. So it's not going to be like it was, but you'd be surprised at how aggressive some banks are getting even on these portfolio non-QM and jumbo type products out there. So that's that market. And the last section I want to talk about is hard money. I get asked about this a lot. I've done a lot in the hard money space in helping people with hard money financing, referring them to people who do hard money. I have a lot of friends who do renovation loans and rehab and flips, and a lot of them use hard money. So what is hard money? First of all, I hate the name hard money because it just sounds bad, right? I mean, it almost sounds as bad as like subprime. But really what it means is, and here's the thing with hard money loans, they're typically not coming from a bank. Most of the companies that do hard money lending, what they've done is they've raised funds from private investors. And so a lot of these, you'll see that they've established a fund where they get deposits from multiple different investors. They pay them out, a return on their investment, and then they control how it is that they lend out on these hard money loans. And the most common hard money loan out there is someone that's just looking to flip a property, right? So you're an investor and you're out looking for a home that might be distressed. It needs repairs. You want to buy that home, you want to fix it up and turn around and sell it. And so a couple things here. One, it might be difficult to get financing from a bank because maybe you own a bunch of other real estate and it's just a complicated transaction and you're only going to hold it for a short period of time. So do you really want to go through all the process of obtaining standard financing that might be approved by Fannie, Freddie, or by a portfolio lender? You're like, no, I don't want to deal with all of that. I just want to get this done quickly and get this home done and whatnot. Or it might be a home that's in such disrepair that it's not eligible for standard financing. It doesn't meet the collateral requirements to even be considered collateral on a standard mortgage. And so for one of those two reasons, you might choose hard money. Interest rates significantly higher. You're going to pay a lot of points up front, typically 2 to 4 points. So if you're borrowing $100,000, you're going to pay between $2,000 and $4,000 per $100,000 that you're borrowing. These are typically shorter term loans. They're like 6 months in duration, might be able to do a year, depends on what you're doing. And you're probably going to need some down payment, at least on the acquisition costs, including your renovation. So if you're buying a home for $100,000 and you're going to do $50,000 of renovation, a lot of hard money lenders are going to want you to have 30% down of that whole 150. Now, there's definitely hard money lenders out there that will require a lot less than that down, especially if you have a track record, you've done multiple transactions with them. Look, they want to deploy their money, but they also want to limit their risk. And so as you build a relationship, you could do that. And the reason I bring this up is because I think there's opportunity out there in the market. Not as much as there was, but I think there might be opportunity in the future. And so if you're somebody who's been wanting to get into the real estate game and you want to be able to purchase, find distressed properties, renovate them, sell them, make some money doing that, you're going to have to really understand the hard money business. And instead of hard money, I like the term like private money. These are really private funds. These are individual investors who've basically have money in savings, and this is a way for them to invest it and get a return on their money. So that's hard money. And if you are in the real estate game and you want short-term financing to help flip properties, things of that nature, you're going to want to look into hard money loans. You're not going to find these typically available through any of the banks, through any of the mortgage brokers or mortgage bankers out there. Now, if you do find a mortgage professional who is very well versed in helping investors with their financing, chances are they're going to know some of the private firms out there that would do hard money loans. Look for companies with the name Capital in their bank, right? Or in their company. So ABC Capital might be a company that either invests in businesses or they might and do hard money loans. So that's what I would look for out there. But chances are, if you have a great real estate agent and a great mortgage person and you're interested in doing this, if you ask the right questions, they can point you in the right direction. Even if they can't do the loan for you, there is a lot of reputable hard money lenders out there that could help you out. So to summarize, I just wanted to give the quick rundown conforming and government, conventional and government loans, pretty simple. Jumbo, all of a sudden, it starts getting a little bit more complicated because these cannot be just packaged together and sold on the secondary market like the conforming and the government loans are. These are going to be underwritten to individual specific investors in most cases. Those investors are going to have slightly different guidelines, and they're going to hold on to that loan and service it themselves, etc. That's going to be your jumbo. That's also going to be your portfolio loans. I will say that a lot of larger independent mortgage banking companies, they do have relationships with sometimes regional banks in different parts of the country or whatnot, where they can offer these non-QM or these portfolio loans, but it's typically not that they're the ones doing the loan. Most mortgage banking companies aren't looking to do that. They might service the loan through their servicing arm if they have that, but the loan is staying in the portfolio of the bank in almost every case. And that bank is ultimately making, the determination on what those guidelines are going to look like. And then we get into the hard money space, which is really for short-term financing. It's typically not available through a bank. It's through a firm that is typically aggregating investment dollars and manages a fund. And then that fund is being used to help investors do short-term financing, and then they look to pay that money back to the investors. So you guys, I hope that was a helpful rundown of the loan products that are out there today at a very high level. I'm curious if you have any questions or think that we should do an episode where we dig deeper on any of these different categories or a subcategory thereof, please let us know in the comments. I'm happy to dig deeper. The intent here was to give you a quick overview of what's out there, and hopefully it spurs up some additional questions that you might have. Feel free to reach out, put them in the comments down below, and we will be either answering your question there, or if there's enough interest, we'll do a whole nother episode. And until next time, you guys, this is Market Shares. Please like and subscribe. But more than that, just tell someone about it. Tell a friend in the industry. Tell someone who you think might appreciate understanding what these different loan options are. Tell them about the podcast. We would sure appreciate it. Until next time, take care.